guys know, we are a community-based group. We trade in the stock market. And one of the particular things that we do is options. And that's what we're here today to tell you guys about, to show you guys how it works, how you guys get started even, especially at times like this, everyone's stuck at home. This is a pretty good way to make, some extra money on the side, to learn a skill even, because it's really a skill that you could learn and make money from, just like probably any other job or any other craft. All right, so getting started. So one thing I wanted to point out to you guys is this is the most important thing because when starting something new, because it's going to be a journey. It's not an overnight thing. And one thing that I wanted to point out to you guys and to basically have you guys think before even starting is, why is it that you want to trade? There could be many reasons. It could be for extra money, retirement, depending on your age group. It could be that vacation you always wanted to go to with your family, for yourself. It could be that you're saving up for a house, a wedding, or even your dream car. I'm saying all these things because you could really profit off of trading options specifically, and it could really provide you with that income to do any of these things that you want. As if it's vacation or even a car or a house. So the reason why I want you guys to focus on your why is because this is a long journey itself, and knowing your why and why you want to, you know, trade in the first place just keeps you focused throughout the journey. So you know that, okay, this is what I'm trading for. Every day you wake up, you trade and stuff like that. This is how much I want to make today, in order to, save money for this or save money for that, to get out of debt, things like that. So do know your why. This is very important. And another thing for, those who are starting off, or those who are probably already, investing, is the brokers. No, having a broker, well, you can't trade if you don't have a broker. But there are a few out there, who are good at one thing and others that are still, in the midst of getting out there. And two of them that we mostly use is Robinhood and Thinkorswim. I myself highly recommend Robinhood, because they're very user friendly, great for beginners, and very simple to start. It takes very minimal to start. You could literally sign up right now, and you could be ready, to trade by Monday. And then we have Thinkorswim. Thinkorswim is very reliable. It's a more intermediate base platform for intermediate traders and advanced traders, but it's very reliable, very consistent, fast order execution. So those are the two brokers that I would recommend, for starters, and for people who probably looking for something else, probably transitioning from Robinhood, or trying to look for something else. Thinkorswim would be better. But there are different brokers out there also. You also have Charles Schwab's, Tasty Trades, E Trades. There's many different ones, but it all depends on your style of trading. As you know, as you get more advanced, or you probably are more advanced, you'll see that certain brokers fit your personality, or your goals better than others. So based on that, you'll know what to choose from. And a few other important things are your sources. So, this is trading in the stock market is, it's a lot of information that you have to digest, because it relates to the market, what's happening, in China, Asia, here. So having sources that keeps up with these news as they come out is very important. And one of them, it's my favorite really, it's CNBC. CNBC have live coverage pretty much from every corner of the world. If someone calls in China, you'll know about it. It'll be live news. So I pretty much watch CNBC throughout, my trading days, Monday through Friday, even on the weekends also, to keep up with what's going on in the market, to know, okay, what my next move is going to be, what stock am I going to play, how to position myself for the beginning of the week. Another thing is TradingView. TradingView is I mostly use it for charting stocks, because that's a very important thing also. Technical analysis, looking at chart patterns of stocks. And I use TradingView for that. It's very simple. It's free. You know, everyone loves free. It's free and it has, you know, it's very user friendly for beginners, for people who are starting off, and the interface is very clean. So I do recommend that also. They do have other things other than just charting. They do have news and things like that, but particularly I only use it for charting. And then you have bar charts. Bar charts is a website. It's very, how do I put it? It's very informative. Yeah, it gives you company balance sheet, cash flow, everything you need to know about a company before you invest in it. It gives you all these details, and that's very important before you get into a trade. Uh, Even if it's for, you know, the short run or the long run, it's very important to know, okay, how are these companies doing? Are they profitable? Are they making money? Have they been making money? And bar charts provide you with these informations, and I highly recommend that for people who are starting out. And just like the brokers from before, there's many sources you could use: investing.com, Yahoo, and for my iPhone users, you guys probably know this app right here. You probably never use it, but this is the stock app that comes automatically with your phone. It's I've never tried it myself, but it's something that you could also, you know, you could use yourself. Okay, so another thing that I wanted to cover before we get started is discipline. This is very important. You have to discipline yourself. Like I said, this is a journey. You're not gonna get there overnight. It's a cycle that you have to repeat. You have to conform yourself, you know, in a certain way. So you have to have some rules for yourself. A few here that we have is you know, don't trade with hope. Don't hope that, okay, you get into a trade that is just gonna execute and you're gonna make money from it. You do have to do your analysis, your due diligence. You have to, you know what you're doing and not just get in there and hope, okay, let me just put $100 in here and hoping to make 1,000. No, you have to be on point. Don't trade with emotions. That's that's the most important one of all, I would say, because as you know, when you're emotional, you don't think straight. And trading with emotions such as anger or well, mostly anger, really. If you're trading with anger, you're not thinking straight, and you're like, oh my god, I just, you know, lost $100. I don't want to do this anymore, and things like that. And all, you know, throughout this whole time that you're mad and you're angry, you're missing out on an opportunity that could have made you that $100 back or even more than that. So these are some rules and disciplines for you to follow. Don't fall in love with one stock, right? Number 6 right here. This is very important because trading options, you could make money from every stock. You could choose to trade. You could choose to trade one stock over and over. But why would you want to do that when you could really profit off of the millions of stocks out there in the market? There's literally a lot, millions of companies out there that you could invest in and make your money from every day, every second throughout the week. So these are some rules for you, some do's and don'ts for you guys to, you know, really focus on. There's more don'ts here than do's, and that's okay because, you know, there's more things that you should not be doing than there are things that you should be doing. Because the only thing you should be doing when trading is disciplining yourself and making money. Those are really, you know, that's what you're trading for. Those are the really, you know, important things that you should be focusing on. So I'm going to move on from that. And another important thing is risk management. Uh, in all investments, you do need to manage your risks. You have to know what are you comfortable doing, what type of risks you're comfortable taking, and the ones that you're not comfortable taking. That adds to the discipline also because you don't want to always jump into a trade, you know, just because you think, okay, I could profit from it. Maybe that's not your type of stock. Maybe, you know, that's too much money for you to spend. You know, all these things are in risk management and things like, you know, how much are you willing to start with? So when let's say you're starting to invest, right? You have your broker and you're ready to, you know, put a certain amount of money in there for you to invest in. It could be anywhere from $500 to $1,000. It could be $10 really. It's possible, believe it or not. Or it could be 30,000, however much you want or you're willing to start with. That's one question you should be asking yourself when you're starting. How much am I willing to start with? How much disposable money that I could put aside for investing that will not affect me on my, your day-to-day life or your day-to-day activity. And like I was mentioning before, um what risks are you comfortable taking? That's another thing that you should always keep in mind. And how much are you willing to lose to get out of a trade? So you may enter a trade and you're not profiting off of it. Let's say you put in $500 and you're still in the trade and you're losing 400. Are you willing to stay? Are you willing to stay to see if it's going to reverse back, for you to make your money or even more to profit off of it? Or are you going to stay and ride it out? Or are you just going to sell and be like, okay, I lost $400. I still have $100 left. Let me just take that $100 before I have zero. So that's another thing that you have to know when it comes to risk management. Excuse me. Another thing that applies to risk management is your account value. Certain trades that you will be getting into, they have a cost, they have a premium. It could be $10, $50 for you to pay to get into that trade. And another important part to risk management is your percentage, the percentage that you're willing to risk of your portfolio. So I have some examples here. Let's say you have an account size of $1,000. We usually, well, not usually, but the smart way of investing is usually risking 1 to 5% of that portfolio. So like I was saying, let's say you have $1,000 in your portfolio. The maximum that would be recommended for you to risk at a time is $50, as you can see, for the 5%. Anything between 2 and 3, that's the golden spot right there. You may think that, okay, maybe $30, is probably not enough for me to invest in order for me to get something back. But really, like I said before, you could really start with $10. You can invest with $10 and really turn it into something. Um, for example, right here, this was one of our position in Domino's. This really happened. Um, it was an overnight thing because they were reporting earnings. But we literally invested $35 into one contract. As you can see, one contract, we bought one contract. And that $35 investment got us $2,700 back the next day because they reported great earnings. Thank you, Carol. They reported great earnings. Let's see what's going on here. Sorry. Just give me 1 second. Yes, they reported great earnings. And that $35, we were able to turn it into $2,722. And that really goes to show you that although you're not risking much from your portfolio, it could literally be $35. It goes to show you that you could really profit off of it, although you're not risking that much. And let's say I had even gone and risked even more, the return would have been greater, but the risk would have been, not in my favor. So that's why you have to know your risk to reward ratio. I was willing to put in $35, to get that amount back. Well, I wasn't expecting that, but this is what I got out of it. So that is a very important part to know in terms of risk management. And a few other things that before we get started, well, before Will goes into, well, not Will, but Omar goes into, what is it that the financial market is and how to invest in it, is implied volatility. Um, when you're looking at a stock, you want to make sure that it is very active. And a way of doing that is by, looking at the volatility of the stock. How much does it move on a daily basis, on a weekly basis, doing earnings throughout the week, throughout the month? That gives you a clear picture and a clear view of how you want to position yourself to invest or to trade that stock itself. So looking at historical, past historical volatility within a certain stock during a certain time is very important. It could really tell you, okay, this happened 2 years ago, during this time. Let's see if it's going to happen again, this year around the same time again. So implied volatility is very important when calculating your risk also, because like I said, it does tell you how a stock is going to move or if it's going to move. So before you could invest in it, and take a risk of putting your money in there, it gives you a clear idea. Okay, if I invest in this, is it actually going to make me money? So that's another thing to keep in mind. So we're going to be moving on to Omar, who's going to be telling us about the financial market. He's going to introduce himself in a few, and I'll say a few also.
Good afternoon, everybody. This is Omar over here. How's everybody doing? Let's get started with financial markets and what are financial markets. Financial markets consist of money markets and capital markets. The money markets are markets in which short-term financial assets that are close substitute for money, such as loans, annuities, and bonds, are traded. We don't focus very much on money markets because we trade the capital markets. And the capital markets are broken down into two. You have the primary market where investors can purchase shares directly from the company itself. And then we have the secondary market where investors buy and sell securities among themselves, which that brings us to the stock market, markets where entities can trade financial securities, commodities at low transactional cost that reflect the price to supply and demand. Basically, that's where we go to trade our uh, financial assets, stocks, and whatnot for us to trade. As Phil has stated earlier, you need a brokerage account. We trade in the secondary markets and not in the primary markets. Hedge funds like private equity, they are the ones that are mainly involved with the primary markets, and we focus on the secondary markets alone. Let's move on to the next slide where we have capital markets. So since we invest in capital markets, we wanted to bring a general view as to how most people invest in the capital markets. Most common investors invest in stocks and exchange traded funds, also known as ETFs. So for those that don't know what ETFs are a group of stocks put into an index designed to provide a diversified portfolio or to capture gains from an entire sector. For example, you want to be in the technology sector, but you don't know which is the best company to select in that sector. You would then go and buy the QQQ index, which tracks and basically has most of the technology companies in that index itself. So average stock market returns approximately is 12 to 19% over the last 100 or so years. We have had years where the market has overperformed and returned a lot more than 12%, such as last year. We had a return of almost 29%, only to go into the sell-off to give it up for the coronavirus. But our goal as traders are to average 1 to 5% on a daily basis. Sometimes it's not easy to do, so we try to average 1 to 5% on a weekly basis. If you're able to average 1 to 5%, or even let's just keep it at a minimum, 1% of your account size per week, your average return should be about 52% annually, over 19% the S&P 500. And that's mainly trading stocks. If we were to trade options, now you could triple and quadruple that return. So we will go to the next slide where we're going to talk about stocks. What is a stock? A stock is a share of a company. It's a portion, a fraction of ownership. If you were to buy a stock, you own a small piece of a company rather than being outright, a 10% or 5% equity holder in the company. There are a number of shares, a certain number of shares out there in the markets, and those shares themselves are then bought and sold between different fund managers and individuals and retail traders like ourselves. And if we were to go into a little bit more details as to options, because that's what we really do. What is an option contract? Options are options give the buyer the right, but not the obligation. So the seller, the person who sold you the contract, has the actual obligation to exercise it. It gives you the right to buy a stock at a certain price at a predetermined date. So the actual definition goes like, options are financial derivatives of the value of 100 shares of a given stock that gives buyers the right, but not the obligation to buy or sell an underlying asset at an agreed upon price, which is known as the strike price, and the date, that is the expiration date. So some people don't understand what is the definition or what does it mean to actually have a financial contract. A financial contract is an arrangement that takes the form of an individually negotiated contract, agreement, or option to buy or sell, swap or repurchase, or other similar individually negotiated transactions. Also, options are also known as derivatives. And what are derivatives? So a brief definition of derivatives. Derivatives are a contract between two or more parties whose value is based on an agreed upon underlying financial asset security. So for example, if we were to say Apple, that is the underlying stock. The option contract is the contract that you would trade. A strike price would mean the price that you would want to buy it at, and the date is the expiration date of that contract. Now, Willy Wonka will be going into more detailed depth for our options and contracts and the different strategies that we use to trade them.
What's going on, guys? This is Will. From now, have you heard about how can you get started in options, what brokers to use, TD Ameritrade, Schwab's, even Robinhood. Right now, we're going to get into what an option actually is. Omar already explained to you guys, one option contract equals to 100 shares. So as you can see on the screen right now, in option contracts, they are financial derivatives. Now, a lot of you guys might be asking, what are derivatives? Derivatives is an instrument whose value is derived from something. So like Omar explained to you guys, the stock is itself and the option is what's being derived from that security. One option contract again equals to 100 shares, and we'll be moving on to the next slide right now. Options, most US stocks, futures, and NDCs have options. Again, one option contract equals to 100 shares. If you were to trade options on futures, one option equals exactly one futures contract. We have two different types of options. We have American options and we have European options. American options, you can exercise at any given time prior to expiration date. While European options, you can only exercise. If I were to buy a contract by Monday and I have it 5 months out, I have to ride this thing through the pain and agony until expiration date. That's when I'll be able to get out that trade. Why trade option? Most people, when I first started, I blew several accounts. I'm not gonna lie. Most people will tell you that when they start trading stocks itself, they don't know the ropes to it, they don't know how to do it, and they go into a risky asset as options, you could literally get obliterated. And you guys probably heard a lot of stories. Why trade options? Because it gives you control of a stock without having to own the actual stock itself. You control more stocks like the Google, the Teslas, Amazon. Amazon's at $2,000 right now. Can you guys afford 100 shares of Amazon right now? You won't be able to, but with the option, you'll be able to control that with just a fraction of that money. And for people with small accounts and who just starting, it is a great way for you to leverage your account. Let's get into the next slides. What is the two components of options? We have a call option and we have a put options. Right now, we'll get into what is a call options? Well, a call option is a bullish strategy. What does it do, right? It gives you the ability to purchase the stock, like Omar and Phil said, at a predetermined price and a predetermined expiration date. So you're locking in the contract today. It allows you to trade in higher price stocks like the Google, like the Amazons, like the Teslas, like the Berkshire Hathaway. And most importantly, if you do have a very small account, that help you leverage your account. Let's get into some examples that we have for you guys. So one side, we're showing you ownership, and on the other side, we're showing you what the option look like, right? So on one side of the screen, we have 1 share of Apple. So we actually did this, and just to really show you guys just the other day. So we went out as market risk trading the company. We bought 100 shares of Apple, and it cost us $27,000, 300, right? That's to own the stock. Now I have ownership of those stocks. I could hold it for 20 years, 50 years. And as long as it keeps appreciating in price, I'll keep making money, right? On the other side, we have the option, which is a call option, right? Let's say we were to buy the June 5th, 270 strike call. That option contract premium, that is the price you pay to get in to control those 100 shares of that company. It costs you $1,000, 845. Now, as you can see, the cost, one contract again equals to 100 shares. So which means that $18.45 turns into $1,845. Some people would say, why would you do something like that? Look how much money I'm risking to make money over time. And look how much money I'm risking on the option side to make it pretty much about the same profit that I would make if it would have to have the same price movement to the upside, right? I would only risk $1,845 compared to risking almost $30,000. Let's go to the next slide. We're going to show you a little bit of, information. If the stock were to move $100 in theory, the cost of the 100 shares costs us about $27,000, right? If it moves $100, 100 times 100, you're profiting $10,000. Now, with the option, it gives you the right to purchase. You don't have the obligation. Only the seller of an option has the obligation to do whatever you choose if you choose to invoke that right. So at 270, you now can sell the stock at 370, which is $103 difference from your strike price. Your gross profit would then be $10,300. Your net profit, you always have to do this. Right now, it's commissions free, especially Robinhood. So you don't got to pay commissions on a lot of things now. They're pretty free. I know Schwab's transactions fees like 50 cents. I believe TD Ameritrade is the same thing too. But look at my net profit. I'm able to average 8,455. Now, how did I get to my net profit? So for my total equity, I would subtract, right, the price paid to get in those contracts to really see how much I've made from those contracts. So that would be the 10,000 overall, which is 10,300 minus the price paid, which is $1,845. And now my net profit for the day or for the period of time that I traded this contract is $8,455. Now we show you guys the difference between the two to see you're risking $30,000 to make $10,000 compared to risking $1,845 to make approximately the same money. Let's go to the next slide. Now let's calculate the return on those plays that we got into. So if that were to really happen, we'll be averaging about 36, almost 37% with the stock ownership of the stock. We could sell it and get that profit, but we could also we're risking a lot here. Now, a lot of people may be like, you know what, I'm holding Apple for 10 years. That's perfectly fine because you have short-term investors and you have long-term investors. But for people who wants to get in now, and let's say Apple stock fell $27, guess what? Now that's what you call dead money. You wouldn't want to sell your stock and take a like $10,000, $5,000 loss. But me on the option side, of course, I'm averaging 460%. And I'm risking only $1,845, guys. So that's the difference that we're trying to show you guys and how to mitigate your risk. Although option is a very, very risky asset, but if you do the discipline, if you have proper strategies and a plan for yourself, you could be very profitable in options, as we've all been doing for the past 6 months. We've been pretty averaging quite a decent amount of money. We've been able to do things that we want to do while quarantining in our house. And that's why we choose to have this webinar for you guys. We're going to go to summarize a little bit of which we just went to. Now, the power of call option in stocks, right? You could make a lot of money in stocks. Again, it allows you to monitor better quality stocks, the Apple, the Amazon, the Microsoft, the Berkshire Hathaway. And again, guys, remember, with a call option, it enables you to leverage a small account. If you don't have a lot of money to start off with, if you have the proper risk management, if you follow what Phil told you, if you follow what Omar told you, you could be profitable in the stock market, in the option market. Now, let's get into the second component of an option. We do have what we call a put option. A put option is a bearish strategy. The only way to profit from a put option is from the stocks falling, going down. A company had bad news, it go down. Like, I remember one of our members, Omar, he made about $50,000 during the sell-off. Why? Just literally on Amazon. You know, we did the chart analysis, we followed the news. Nobody knew when this thing was gonna come. It just came overnight. And everybody wake up the next morning, it was just a bloodbath. And that bloodbath continued weeks after weeks, weeks after weeks, and until we probably bottomed out, which we really don't know if we did yet. We might go back to retest the lows or go halfways. We don't know, but he profited by playing the put option. So let's see how. So guys, you have 100 shares of Apple, right? You have 100 shares of Apple. It costs you about $27,000. If you were to lose $100 on that, you'd be losing about $10,000, right? Considering the option size of the stream, you only risking to lose $1,845. So I just want you guys to see the bigger picture of risking a lot of money to make money or risking a little bit of money to make more money. I would rather the option side while still investing in having ownership of stocks. So one of the things that we do before I continue again is we invest in the option market. Whatever profit we make, 25% of that goes into ownership of a stock. That way you're playing option, you're not risking it all. Your hope is not a strategy. Remember, that's the first thing Phil told you. Don't go into the stock market and hoping that the market goes up or hoping that the market keeps going down because you do not know. So we'll get into short selling versus put options on the next slide. Well, let me get into what a put option is. Again, it gives you the right to sell the stock to someone else, right? At a particular price again, and at a particular strike price. So which means you're choosing your strike price, you're choosing your expiration dates, whether it's 2 months, 3 months. We like playing long because guess what? It gives you the luxury of time. And you're not being affected by our best friend, theta. Theta is what we really pay attention to a lot because it could really affect us. Time values really matters in option trading. Now, it allows you to take advantage of a stock collapsing, which means if the stock is going down, like when we had Apple, some of us have bought it at 290, some of us have bought it at 300. So we kind of took a loss on that, right? On the ownership of the stock, which is dead money. But guess what? We were able to be profitable on the downside because of the put option. It gave us the ability to still make money while we're still on a losing position because we know Apple is a value stock. I don't think it's gonna go bankrupt within the next 20 years or 50 years at it because they keep renovating things and they're everyday stocks for everybody. We're gonna go into the next slide. Like I said before, just to reiterate that to you guys, excuse me guys, just to reiterate that to you guys, it gives you the right to sell the stock to someone else in the market at a particular price and a predetermined expiration date. Like I said again, you profit from this from the stock falling. So if Apple was trading at 290, it drops to 270, and you have a put options up to 285s, you'll be able to profit off of that. It allows you to manage your portfolio, to hedge against your portfolio, and to save a lot of money, right? You're not risking a lot of money to make money. Again, it's about leveraging. Now, one of the trades that we had got into, which was, I think, Thursday or Wednesday, we choose to put it there for you guys because it's a prime example. So the next trade, 1 second, there we go. At the time, Intel was trading at $59.85, right? Now, when you short sell a stock, the losses are infinite. Like if the stock, if it goes the opposite direction of which you're betting, you will keep losing money as it keeps going, right? With the put option, remember, you can only lose the premium paid for those contracts. You can't lose more. So you're paying out, again, almost $30,000 to short 500 shares of Intel. So literally, this is how short selling works. I go to a broker, I'm like, you know what? I think that Intel won't be reporting a good report on Thursday. So I'm gonna borrow 500 shares from you, right? I'm gonna borrow it. And let's say the stock fell down to $5 to $54.85. Now it's gonna cost me $30,000 just to profit of $2,500. That is a big risk you're taking. Compared to the other side of the put options, right? Your profit when the stock is falling. You buy 5 contracts of the $60 puts, which cost you about $2.88. And guys, remember, 1 contract equals to 100 shares, right? So that's $288 multiplied by 5 contracts. That will cost you what? $1,440. Now remember, it gives you the right to put the stock at $60, which is your strike price, to someone, even though it fell to $54.85. So your gross profit from that would be what? $2,575. How did we get there, right? The strike price minus the price the stock was trading, that's $5.15. Multiply by 100, that's $5.15. If you multiply by the amount of contract that you picked up, which was 5 contracts, that's gonna cost you $2,575. Now that's your gross profit, right? To see how much you really made, your net profit, you minus that from the price paid to get in the contract. That is $2,575, which is your total equity, minus the price paid to get into contract, and now you have $1,135. Again, we have this here to show you guys, you don't have to risk a lot of money to make more money. With discipline and proper risk management, you can really be profitable in the market. Let's go into the next slide, guys. So shorting the stocks, you're risking about $30,000 again, just to make about $2,500, right? It's about 8% return. But look at the return, you're risking less money, right? And you're averaging about almost 80% return in the option chart. So it just kind of show you the advantage or the benefit of using option trading, right, to hedge against your position, whether it's to speculation or arbitration at all, if you do trade outside the US markets. That's something we'll have for another webinar. So let's go into meeting our favorite people in the world right now. Is meet the Greeks, guys, because that's really important. These are what moves in option contracts, literally. Knowing these things works a lot. Like Phil and Omar and Cassie and probably Christina have already told you guys on live again, join our Discord chat. It's free right now. Everything is just free to you guys. It's an educational based system. And we're just trying to educate the community on really how to be profitable, especially being home and not doing nothing. You're getting laid off, your business are closing, people are not working. You got to find a way to bring different incomes inside the household. You got kids, you got bills, because guess what? The bills doesn't stop coming in. The guy you paid the mortgage to, he wants that money. That phone bill, they want you to pay. That loan that you had, they want you to pay. It's gonna, people don't care. It's just a hard time. We all are going through it, but having a different set of skills in your pocket probably will definitely help you. So let's get into the Greeks right now. So option Greeks, what does that help you? The Greeks are a pretty cool way to measure the sensitivity of an option price, right, to stock prices. So what it does is it tracks stock prices, market volatility, and it time value, which is timing, time decay, right? So let's start with delta. Delta is our favorite friend. The higher the delta is, the happier we are, guys. Delta refers to how sensitive the price of the option is to every $1 movement in the asset, the stock, right? So delta could either be positive or it could be negative, depending on the side of your choosing, right? It could either be a put options, it will be negative, or it could be a call option where you will see the delta will be positive. Now let's go to gamma. So now we went in delta. Delta measures the stock. Now we have gamma, who measured delta for every $1 move in the stock price itself. So again, gamma is used to monitor price change of the option to decide if an option is in the money or out of the money. Those are terms later on that we're going to go over just so you guys could understand. Later on, we're going into Vega, right? You guys need to get used to that. Vegas highlights how often the option contract price changes relative to a 1% increase in the underlying assets implied volatility. That's why Phil was telling you guys about volatility. It matters. It shows how profitable you could be to expiration date if the contract were to end in the money or out of the money, right? Essentially, it's a way to measure how fast the price of an option will go up, right? Or down. Last but not least, guys, we're going to our best friend, Theta. So Theta is considered to be the enemy of most option traders. Since we're buying option contracts in the market, you could imagine Theta affects us. But the seller of the option contract, it is the best friend, because as we're losing money on option contract because we're the buyer of the option contracts, the person selling or writing that contract in the market is sitting home with his hand like this and making money of your money that you put in the market, trying to make money for your family. So it is essential that we pay attention to that. So as you see, as the definition says, it measures the decline value of an option over time as it reaches expiration. Every moment that passes allows some of the time value of your option, of the money that you invested, to fade away. And not only does the time value deteriorate over time, as it gets closer to expiration, you're losing a lot of value at a rapid rate. And guess what? That's why most people sometimes be like, oh, my option is worthless. Or they buy a weekly option. They wonder the next day if the stock doesn't have a big movement, right? A big price movement. Even if the stock have two movement, the contract is still worthless. They can't be profitable on that option contract. Now let's get into something else and go on to the next slide, guys. So again, I promise you guys the key option terms that we wanted to go over, right? As you guys can see here, I'm not gonna take time to go over everything with you guys. It's gonna be there for you guys. We have what in the money means: at the money, out of the money, strike price, option Greeks, break-even price, intrinsic value, extrinsic value, options premium. We already went over this. Option premium is the price paid to control those 100 shares to get inside the contract. Exercise price. Exercise price is literally if you were in the money at expiration and you choose to exercise to invoke the right to buy those shares, the seller or the writer of that contract need to give you. He has an obligation to sell you those shares at whatever price that it is at the time. We have assignment. We have what long means. When you go long on a stock, you're buying it. Short mean you're selling it. So we have strategies like long put, short put, long calls, short calls. All that is saying is a buyer of an option compared to the seller of an option. Understood? So strike price. The strike price is the pre-agreed price per share at which stock may be bought or sold under the terms of an option contract, right? Some people may refer to the strike price as exercise price, right? Then we have in the money. For call options, this means that the stock price is above the strike price. So if a call has a strike of $50, guys, and the strike is trading at 55, that option is in the money because you're under the market value of what the stock is currently trading at. Let's go into an assignment. An assignment is when an option owner exercises the options, an option seller or the writer. Because remember, because selling of an option is basically the same thing as writing the option. So basically, is assigned and must make good on his or her obligation. So what that means is that person who is selling those options is required to buy or sell the underlying stock at the strike price, right? A little bit of intrinsic value. Intrinsic value is the amount an option is in the money. So obviously, only in the money option have intrinsic value. You guys do understand that, right? So we're gonna have all the definitions in the note sections. If you guys are to download this, all these information is available to you guys. It is essential that you guys know what these mean, especially if you choose to join our group or join any other group out there on the planet or choose to take this journey yourself. It is essential that you know what these terms means and know what it means when you start to trade options or even in the market in general. It's just extra knowledge that is needed. And for you to be good in something, you need to take the time. You cannot be afraid of information. Information is key to everything. Let's go on to the next slide. So right now, there are many different option strategies that me and my team has been very profitable on, right? You guys probably heard of straddles, we've heard of strangles, iron condor, we've heard of call debit spread, put debit spread. There's many of them. All those are ways that once you kind of get into risk managing your account, that you don't want to risk a lot of money, these things will help you, pay a lesser premium to get into those contracts. Now we're gonna get into the top 3 most, in our opinion, that we think that most people use on a day-to-day basis. There are tons of them. If you guys join our Discord, all these information will be available for free. We just want to educate you guys again on how to properly use the information to be profitable in the stock market. So let's get into the first one. So the first one is called the long put. Remember, long equals buy. When you're going long with something, you're buying. So the long put is an option strategy where the trader buys and expect the stock to go down, right? You're paying the premium, which we give you the example of Apple. If it was to go down, we invested $27,000 to buy the stock. If it were to go down, that's how much we'd be losing. Now, to hedge against our portfolio, we'll place some put options on Apple to offset the losses for the time being, right? Because nothing goes down forever and nothing keeps running forever. So everything has to come back to the means and go back up, come back to the means and go back up. So in the stock market, that's why if you're looking at the charts, they go like this. It fluctuates over time. Long put is a good strategy because you expect the stock to fall and you intend to make money from the stock going down, right? It's a good replacement for short selling. Reason being because it reduces the short seller's risk to the premium from shorting the stocks. And it opens the trader to uncapped losses because guess what? You can only lose the premium paid on the option. You can't lose more. Short selling, if you're not watching it, let's say you shorted Apple the other day and Apple was at 273. Then the day after, Apple runs to 283. You're losing money. And the more the stock goes the opposite way, the more and more money you keep on losing when you're short selling. That's why we would recommend the put option because you're able to cap your losses to whatever you invested in that contract, right? So let's take an example. Disney is traded at $100 right now, right? At the time, we placed a put option of the $100 strike price, and it cost us about $1,000. Remember, 100 shares, the contract is $10, multiplied by 100, you get $1,000, right? Let's say we buy for 5 months out. And as you guys can see on the screen, one share equals to 100, right? Multiplied by $10, and that's how much we're willing to risk for Disney, $1,000. Now, this is a P&L chart that shows you over time of your contract how you're going to be profitable. Now, again, you can only lose whatever you put in. You can't lose more than what you put in the put options or in options in general, depending on the side of your choosing. So right now, as we see, as the stock keeps going up and going against you, you're only losing $1,000 because that's how much you put in. As the stock keeps going down, right, you'll only be profiting. As it gets to 110, as you can see, you're at zero. As it gets to $90, you're at 1,000. $80, $2,000, $70. That just kind of show you the P&L, the profit and losses. This is how much you're gonna keep making as the stock keeps going down. Now let's get into the second most used option strategy in the market. This is my favorite one because I'm a bullish. I'm a bull, guys. See this? I'm a bull because I don't care if the market goes down, if the market stays straight, if the market stays left, right. I want to be profitable in the market because guess what? I quit my job. Everybody here in this office, we quit our job to do this full time. So any corners of this, we need to basically master it and be so much make so much money out of it because that's our job now. So what is a call option? This is an example. The trader buys a call because he expects the stocks to go up. So you only be profiting if the stock keeps going up, right? During expiration. So when you expect the stocks to rise up, the long call, the call option is the way to go, right? It's naked, it's risky. But if you do the proper research, the proper analysis on the company you want to invest, if you read like the other day when, before WWE earnings, right? If you conducted a proper research on how the company would report concerning the coronavirus, since everybody's been staying home, people's been watching a lot of shows. People have been tuning into things that they never did before because they're home, they have more time. So we did expect a higher movement in the stock and we were very profitable on it. Now, it may be a smart idea to play this strategy because the stock has the potential to rise much higher. It could go to 100. Like Phil showed you, when we played Domino's earnings, he only risked $35 to make $2,725. So the more the stock keeps going up, the more money you keep making, the more expensive the premium is. And if somebody believes that this stock has more room to keep going up, and you have these options for 6 months, as you guys will see, we do have some screenshots at the end just to show you guys how profitable we've been since, I believe it was October of 2019 into right now. Since October 2019. Thank you, Carol. Another example, it's the same example just to kind of show you guys. 100 shares equals to one contract, right? So Disney's at 100 and you believe that this is gonna go up to 105, which it did the other day. And we pay the same type of premium, which is $10 multiplied by 100. We only risking $1,000, guys. You don't have to pick up 100 shares of Disney. Now, if you believe in Disney and you believe Disney over time will keep going up because it's a value company and it has a great dividend, buy Disney, but manage your risk. And again, this is a P&L charts to show you what the call options look like. And again, keep this in mind, guys. You can only lose the premium paid to get in those contracts. You could never lose more. You're not a seller of an option contract. You're the buyer of the option contract. There's other there's tons of strategies out there. But if we were to stay here and go over each and every one of them, we probably take like 3, 4, 5 hours going over to make sure you guys understand it. It is essential that you guys do your due diligence and deep into this thing, dig deep into it and know it and master it. So this is a P&L chart to show you guys if if Disney were to go the opposite way, this is how much you'll be losing, right? Only $1,000, which if you feel like, okay, I'm losing more than 5, 10, 15%, you know that I got into the trade, cut my losses and start over again. Or like Phil said, are you willing to stay through the trade because you know this news or this strategy in the technical analysis part of it, over time, if you do have the luxury of time on your contract, that it can potentially come down. So it was like the same way that when we traded Tesla or Amazon before the sell-off, it was a lot of bearish divergences happening, but nobody really knows as to when they occurred. It will occur, but eventually it had to happen. And a week after, Amazon dropped $200, $300 back to $1,600 again. And that's how we was really profitable on it. But again, in an option contract, whether it's a call option, whether it's a put option, you can only lose the premium paid. So you're not risking $30,000 to pick up 100 shares because you believe it's gonna go up, right? You're risking just a little bit of money to try to make more money. And whatever percentage gain that you receive, we do recommend that you keep taking it because you wanna gradually grow. You do not wanna be greedy because greed is what kills people, right? When you, Carol said that's me right there. But it is true, guys. As a trader, everybody has a style for themselves. Let's go to the next slide. And this is one of my favorite ones that I like to play for earnings. Carol herself knows that because I was part of a group with her as well. And one of the strategies that I sent a lot to that group was the long straddle, right? The long straddle strangle is like the long straddle, right? So it's easier to set up because it uses out of the money option instead of at the money options, which would make the option more expensive. So over the long terms, the buyer owns a call and a put option at a price over and below the existing stock price. So to exchange things off a little bit, right, compare the strangle to the straddle, is that the stock has to make big moves for it to work, right? So the strangle itself, you're buying a call option, one's gonna cost more than the other, right? Or let's say you have Apple and Apple's trading at 273 and it was Apple's earnings next week, right? You don't know which way Apple's gonna go because their supply chain's been hit. You know that they're a value company and you're not sure or if they're going to withdraw guidance or what the hell they're gonna say in that earnings. So to protect yourself, you get into a strangle. The call might be more expensive than the puts. So when you expect the stock to jump much faster than you will, you have a long strangle and you're playing a major change in the stock. The long strangle will be cheaper to set up, right? And offer a better percentage return than the straddle, because the straddle, which we're not gonna go over, is you buying the same strike price for the put and the call options, which is a lot more expensive than the strangle, because the strangle, you're paying two different prices. One is cheaper than the other. So if you're playing an in-the-money call option and an in-the-money put options, it's gonna be pretty expensive. So if you guys were to go on Robinhood right now, or whenever you guys have the time, try a strangle. You go on Robinhood, click select, right? The same strike, let's say the stock is trading at $100. Click on one call option for Apple at whatever price it is, the same strike price, the 100, let's say Apple's 273, the 280 calls, right? Get the 280 calls and get the 280 puts at the same time. And you guys will see how much it will cost you to own that one contract. Within that one strategy, you can pick up more than one contract of that strategy, which probably is more expensive. This is why we're giving you guys the strangle here. So let's take Disney again. Disney's at $100 a share. and you have a put for the $91 strike, and it's available for $5, and it expires in 5 months. And you have the call option with a $107 strike price, and it's available for the same price, which is $5 with an expiration for 6 months. The total cost to get in the trade, because you're paying $500 on one side, you're paying $500 on the other side, is $1,000, right? Now, this chart right here shows you what you could lose on the trade. So the maximum downside of the long strangle is the complete loss of the premiums paid. So all these strategies that we showed you guys, you cannot lose more than what you paid. You cannot lose more. So you're indecisive of how stock gonna go. It has to the next slides, just to kind of go over everything that we went over today, right? Now, this is showing you two different stands of you buying, being the buyer of a call option or put option, or being the seller of a call or put options. So if the stock are declining, right, declining stocks, what would you do? You'll buy puts because the stock is going down. You can only be profitable if the stock going down in the put options. Now, if you're the seller or the writer of a put options and the stock is declining, you would want to sell call, right? Why would you sell a call? It's the very same reason why we buy a call, because we believe that the stock is gonna go up. If I'm on the opposite side of the screen, if I'm writing that call option in the contract, I believe that the stock is gonna go down and some dummy probably gonna pick it up. So I want to collect the premium. Same thing for a rising stock. If you're the buyer of a call option, you want the stock to keep appreciating in price, right? If you're the seller or the writer of a call options, what would you do? You'll sell a put option because you want to collect that premium paid, because that person believes that the stock gonna keep going up when eventually that it goes down. Now, if the market is flat, what do? You could play a strangle, which we went over, or you can play the straddle, right? Now, we'll have everybody on here to kind of just go over to you guys how profitable we've been. This is not to kind of like, you know, gas you guys up or to say this is a scam. You could do this yourself. You can take all this information that we give you today, right? And you could go and read books, go on the internet, find it yourself. If you really take the time to master this could be something for you too. Like, you could really be profitable in the stock market, especially in the option market. So these are just some profits that we have. This was, man, I show this picture right here because this is when we made about $50,000 in Tesla. And we got these contracts back in October. In October, guys. That's when, right before Tesla earning, you know, they weren't making any profits. Everybody was bearish on the stock. And once the stock started running, they started calling it a cult stock because it just never stopped. Everybody just keep buying because they believe that Tesla would hit the moon. So when I purchased these contracts, you guys could see, I literally paid $10 fucking, guys. I don't mean to curse, but this is like a dream come true because I've never made so much money in just so little time without me doing anything, right? If you guys check on January 14, 2020, guess what price that Tesla was trading at? No, at the time, it was literally trading at $539. As you guys can see on the screen, I had the $500 call. So you guys could imagine how much these option contracts move by. And I had 30 of them. I had 30, and my break even was $520. It passed my break even price. And the picture on the side was a recent thing that we got in. That was the day of before earning, which I was already up, just to kind of show you guys how this thing works. And we was already making $33. The day after, we sold these contracts for $200 profit, right? So let's go to the next slide just to kind of show you guys some more profits. There we go. This is another profits of Tesla in February. Guys, look at the percentage return on these contracts. This is fucking ridiculous, guys. Like, this is money that you're making just sitting at home and being able to do proper research and proper technical analysis, guys. We just made $4,000. $4,000. $4,000, man. 4,000. We made literally 100% of what we put in. Look at that today's return, 2,638%, right? And then there was another trade, which I did send that to some people as well, was HPQ, because they were going to be bought out by Xerox. And people was really speculation. This was just speculation because they wanted to be bought out. I don't know. It was just a talk in the news. And I'm like, you know what? Why not follow the news? So I want to pick up 100 contracts. I believe we made $6,000 from these contracts, but this was a week after we was already up $1,000 on the trade. Now, I'm showing this to you guys to show you guys. Now, if you're a beginner in trading, you're making $1,000 in one day, take that dead money and run away with it and come back the next day, right? Reason being is you don't want to risk too much. You just made $1,000 a day. Like my team and now, we've been averaging $5,000, $6,000 a day. Some people may think it's not believable, but it is quite believable. We have 5 people in the room. One is following the news. One is on technical analysis. One is what, like, we yelling to each other. Like, this is like we have our own trade floor. Oh, God, this stock is running. We have our screeners on, and we're just making money nonstop. And I believe during Amazon's earning, we hit that $1 million mark, guys. And this, we're trying to at least get to 2 to 3 million by the end, by December. By December. So I think we have some more profits to show you guys. Damn. Guys, look at Google, right? Those are the big stocks. I'm showing you guys how you could spend a lot of money to make money and how you could spend a little bit of money to make money. So this Google contract here, we spent about $1,730. We bought 2 contracts. So we literally spent about 24. Look at our total return, 97% return, 3,370%. I mean, dollars, that's how much we made in that contract. Look to the right side of the screen now. We made about 11,000. We closed this trade about $20,000. And these contracts, we picked them up at literally 7 cents. But it's different strategies. As you can see, the amount of contracts on the left side is 2. As you can see, the amount of contracts on the right side of the screen, 400 contracts, because they were that cheap. For every 100 contract, I was spending $700. We have a big account, so we could make trades like that. Somebody else could have picked up 25. They could have picked up 50. But we made a lot of money from these things. It is real. It is not fake. We have it out there, and you guys can get into it too. Like I said before, with proper risk management, if you're disciplined, if you're not greedy, you can make money in the market. Because I stopped working. I'm not telling you to stop working because you do need capital to invest in the market. Like Phil said, you do not want to invest money you can afford to lose. The market goes up and down, guys. It is an investment. There's risk to it. But if you take your time, if you study your craft, you could be very profitable. Every trade is different. This is why we're trying to grow this community and make it something much more greater than that. Let's show you guys some more profit. Some more profit. So this is Tesla again. Woo! Tesla just kept running. I don't know. We couldn't have enough of it. It was just like, it was too good to be true. We was like, okay, we made $10,000. Let's see if we could make another 4,000. Because at that point, I believe it was just speculation because it was profits money. We weren't risking our initial investment. And then look at those 30 contracts, guys. Look at those 30 contracts, guys. So this is real. We're not showing you this to get you hyped or to be like, oh, you want to join market risk trading. Nah, we don't want you to join us. We want you to be a part of us, right? Because we want to learn, because I'm still young. I just turned 26, and I turned 26 inside. My hair's going crazy. Look at my beard. So like, we need to find a different way to make money. So that's what I fell in love with. That's what Omar fell in love with. That's what Phil fell in love with. Like, heck, sometimes we take losses too because we're being too greedy. And that's why we want to build a community. We started with the 5 of us because we balance the 5 of us. We balance each other. We're not being too greedy. Omar was like, yo, Will, I'm going to get out because I have a different opinion on this stock. He got out. Next thing you know, the stock went down, right? Same thing on Friday with Zoom. Zoom went all the way to $180, guys, I believe. Then Facebook, it was a news that came out that Facebook was going to do the same thing as Zoom was doing. That instant, Zoom fell about $10 to $15. And we was able to make $5,000 there. So again, You need to be well equipped, right? You need to be well equipped. And right now, we'll take any questions that you guys have. I really just wanted to show you guys the profits that we've made. Like, again, that's why I feel a lot of don'ts and not do's. Because the do's is do your due diligence, right? And make money. And the don'ts is all the negative things, being greedy, hoping, and not doing the proper research. Because if you don't expect to be profitable, then this is not for you. But it could really be something that anybody do on the side, especially if you're already investing in stock trading, right? For the long term, for your kids, for retirement, for vacation. Right now, we're gonna jump into Q&A. So any questions that you guys have, you guys may ask us. I hope this was very informative for you guys. So we'll find a way to make this so you guys could download this. And yeah, so we'll have Omar and Phil answer any question that you guys have. Hey, Carol, I'm glad that you're here. And I know a lot of people that are here too. I'm glad that you guys showed up.